Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Welcome, everybody. I'm so excited for today's conversation with Carson Cook, who is the founder of Tokemak, of Fractal, and is one of the leaders of decentralized finance. We'll talk about how decentralized finance has evolved, as well as the different threads that have brought all of it together and the way that these projects are contributing to the future of our financial system. Carson, welcome to the podcast.
Thanks for having me on, Lex.
My pleasure. So we always start with trying to understand what brought people into the space and their journey along the way. I'd love to learn a little bit about your academic background and then how you caught the finance virus.
Yeah, absolutely. I think I took a bit of an eclectic journey before landing in DeFi. And I think this is something I've seen sort of across a lot of different founders and builders in the space. My background is technology, did a PhD in physics and a master's in electrical engineering, was sort of the perennial academic, if you will. The area that I did research in, plasma physics, in particular, something called magnetohydrodynamics, or MHD for short. And effectively what I was looking at.
That's an X-Men, right?
Yeah, that actually, yes, it's very similar to what Magneto has for powers.
Okay, I just wanted to establish my baseline knowledge of physics before you explain the rest. Okay, go on.
You've got all the important points there if you're following up X-Men. So yeah, so what I was looking at was this area of MHD, or magnetohydrodynamics, is basically magnetic fields coupled in with fluid dynamics. And I was looking in fusion reactors, so these devices that generate power via fusion. So the fusing together of atoms instead of the splitting apart of atoms, which is what you do with fission. And the two types of reactors that I was studying were the Tokemak and the Stellarator. So there is obviously a connection over to Tokemak, which we'll get into a little bit later. But I was looking at different instabilities that could form in these reactors that would prevent them from sort of scaling up to something that could produce energy at scale.
Can I ask an existential question about the physics work that you were doing, which is which parts of these concepts, like what pulled you into them? Was it the sheer difficulty or sort of like the sheer frontier nature of the math required, or was there an organizing principle for what pulled you into these research topics?
Yeah, it's a great question. So my background had always been sort of math, engineering, and physics. So in undergrad, I did triple major in math, electrical engineering, and physics. And I really sort of centered down or centered my focus onto physics going into grad school, because I found that physics was the most elegant or the most beautiful of all the things that I had looked at. And so the thing that really intrigued me about physics was you actually need to know a very small number of things, but very well. And it's sort of these principles out of which everything else falls. And if you can understand these several things, you can basically derive everything else, engineering included. So I found sort of the elegance of physics to be very, very beautiful and intuitive to me. And I think that sort of has guided me going forward in life, in business strategy, and then going into doubling down into DeFi is if I can't understand something at a level where I can describe it very succinctly, I don't think people really understand it. I think complexity where complexity is not needed just is trying to cover up for the fact that you don't really understand something. So that's really what attracted me to physics broadly, was just how simple and elegant it was.
There's a couple of ideas actually that you packed in there that I think are really interesting. I mean, the first is just being able to describe something with mathematics that is then built. I think another one is that simple rules are more powerful than the complex noise that they generate out of their interaction. And then third, the idea of simple rules being composable and coming together, which again, all these things kind of mirror in DeFi and in economies. Can you walk us through sort of how you went from the literal Tokemak to the fintech and kind of consulting and business career that you started? What pulled you out of the academic path towards an applied path?
Yeah, great question. When I started my PhD, I thought for sure I'd want to either go be a scientist or be a professor and do research. And once I got through about 2 or 3 years of grad school, I realized I was already publishing in various academic journals. I was presenting at conferences, and I realized that would sort of be the rest of my career, which, well, I think is a very valuable career for those that choose to stay within it. I could tell that it wasn't going to challenge me sort of enough. So I started looking more broadly. I'd always been very interested in trading in the markets and really economics, but didn't have sort of a formal background in it. But I started trading my personal account in grad school, became fascinated with it, with sort of the emergent phenomena and the collective dynamics that you see within the markets. And I started to sort of form this hypothesis in my head that the three systems that are sort of worth studying are physics, the brain, and the markets or financial markets in general, because there's so much crazy emergent phenomena in so many different ways to look at the systems and describe them that all of them are immensely beautiful and dynamics unfold on so many different levels. So that got me very interested to sort of dive further into trading. I got plugged into sort of the Chicago trading scene, especially in the FX world, started doing that part-time while I was working on my PhD. And ultimately, sort of as a next stepping stone from that, got connected to a number of people that were in McKinsey in the management consulting world. And that was a world that I'd never even heard of, found that quite interesting, and ultimately decided to apply there and approached the interviews very much as a game where I thought, okay, I really have no business jumping into strategy and operations and business and pretending to be like an MBA going and doing management consulting. Let's go see how far I get on these on these interviews, and spent like a week just learning case studies and how you even approach them ahead of time. And it ended up that the interviews went very well. They were very fun, and enjoyed the people that I was working at with McKinsey. So joined there after I finished my PhD, spent a little more than 3 years, and was really focused on fintech, financial services, banking, wealth management, which really taught me a lot, seeing what works very well in traditional finance and things that work very poorly in traditional finance.
Yeah, yeah. So on this topic, my first role in the industry was at Lehman Brothers in a strategy group. And the person who hired me, who was the head of strategy of the group in investment management, was a German astrophysicist who did the same route, who came to Princeton to do advanced studies and then joined McKinsey FIG, and kind of went through the industry. And so it's really interesting how different the outcomes are, right? I mean, you move 20 years in one direction, and it goes from ending up at an investment bank running a very hierarchical type of approach to what is now a very different vector with decentralization and completely new protocols for finance. I want to just rewind for a second and try to get one layer deeper into this observation between physics and applied finance, because this is a transition that lots of incredibly smart people continue to go through, and if you look at the Chicago scene and the large market makers and the quantitative traders, this is a transition that is, I guess, almost like a pattern. Can you talk a little bit about how similar or how different these different systems are? The systems of modeling the world as it is, and then the systems of modeling markets and social interactions. Like, what would you say has been your observation in interacting deeply in both of these parts?
Yeah, it's a very good question. So I think it depends which part of physics you come from, whether you're from sort of applied physics or even more in the direction of engineering versus some of the fundamental physics. So I came more from the applied end of physics. I did theory and computation, so I was still much more on the theoretical end of things. I was looking at equations and modeling things all day. But those that are dealing with something more on the applied end where you have very complex systems, and this is what plasma physics is to a T. There's all these different ways to model and describe the complex phenomena that's happening within a fusion reactor, and you're always getting certain pieces right, but you're getting other parts wrong. That part very well maps over to finance. So it's really, what do you care about? The markets are too hopelessly complex for anyone, at least in current state of thinking in terms of models and compute power. You never get everything right. So rather you figure out, okay, what things matter to me? What is the essence of what I'm trying to model? What can I throw out? And what do I need to have high fidelity within my modeling? And so those types of things map very well over in terms of what type of model do I need to employ here in order to recreate the phenomena that I'm interested in. And I think this also, by the way, happens over in the world of neuroscience as well. You have these things that just have wonderfully complex phenomena phenomena, but that you try to describe in as simple and elegant terms for the specific subset of phenomena you're looking at. And those things I think map very well from physics and the mathematical sciences over to the financial markets. Can opine a little more or go deeper. That was probably surface deep, but
No, it's great. And it's really interesting that you bring up neuroscience as well, and I think there is this friction or this philosophical view that we still hold as people that you can't model populations, or that there's something special about large groups of people, or there's some sort of animal spirit or irreducible irrationality. But my sense is that people in a sufficiently large group are kind of like an environmental variable, that they do have predictable behaviors in some sense.
yes, totally agree. And you can even see it just modeling atoms and fusion reactions within a tokamak. Like there's definitely nothing magical, so to speak, in there. I guess depending on your point of view, you could say it's magical. It is very interesting, but there isn't this consciousness and these things we usually where people consider these unmodelable things, and yet still you get crazy emergent phenomena that are very hard to describe, even though the entire thing is deterministic. In fact, right now we can't describe a lot of those things, and so completely agree with what you would just say with given enough compute power, I think all of those things are just different parameters in the system.
Mm. Yeah, I've been really enjoying the things that Wolfram and Yoshabak have been putting out there on these topics, but that would probably be a hard right off of our main topic, which is going from McKinsey in 2018, which generates a particular path for people in finance into being a founder, and being a founder within an emerging asset class. How did this happen?
Yeah, great question. So in the 2015, 2016, 2017 timeframe, after joining McKinsey, I knew I didn't want to stay at McKinsey forever. I very much enjoyed my time there, but it was it was definitely a stepping stone. I knew I'll learn business and strategy and operations here and management, the things that I didn't have from my technical background. And then I wanted to go build something. So I was really using my time there to both learn the business side, and then on the limited time on nights and weekends that I didn't have, I was monitoring several different technologies to figure out what I would have high enough conviction in to jump ship and go build. And so there was really three things I was looking at. I was looking at crypto blockchain, which of course that's the path I ended up taking. The second piece I was looking at was VR and AR. And the third piece I was looking at was 3D printing. I'm still very convicted in the potential in these other two. In fact, now I think the path is fairly straightforward in terms of what the sequencing would be of these. But of course, in the 2016, 2017 timeframe, as crypto took off, that was the one I decided to go after, especially given my past history in the markets, watching the segmentation of markets at that time, and thinking about the opportunities for a market maker prop trading group. That was where I saw a strong signal. Before we kind of jump further in there, one more thing to say on the VR, AR, and 3D printing side. I think the possibilities there are going to be absolutely mammoth, especially when coupled with crypto. And I think you're starting to see it now with the probably overused at this point in time term metaverse. It's pretty clear that VR and AR are going to have a big piece with that linked in with sort of ownership on the blockchain. And then I think going forward, 3D printing will very much disrupt manufacturing and decentralize manufacturing, especially when plugged in with the blockchain for ownership rights. The reason that will take longer to get to fruition is really a question of a network or piping of raw materials to homes.
It's really interesting to hear you say that out loud as a set of logic, because for me it was also three things to look at, although it was blockchain and crypto, and here we all are. I think we got that sequencing right. And then machine learning, and maybe for you machine learning is just a tool, but I saw machine learning, and not AGI, but just let's say applied artificial intelligence, as a place where a lot of financial things that are interesting could happen. And in particular, I think there's a real risk for DAOs and artificial intelligence to come together into some sort of liquidity black hole. I think we're creating that right now, and in part you are creating that, and maybe Olympus as well. But I think once you start introducing agents, self-determining agents in some sense, we're really in a crazy place. And then AR, VR as well. I agree with you. But I mean, what's wild to me is that I would definitely not have guessed that on such a quick time frame, these virtually rendered worlds, everybody would just assume that they run on a blockchain and are financial. The speed with which we've gotten to that outcome does seem almost bizarre. Like, we are in 2021 surrounded by artists who've become financial engineers. And I feel like a crazy person for noticing this and saying this is strange, and it's become this completely normalized thing.
Yep. I could not agree more. And and it's interesting because I think the three that you were looking at, machine learning and AI, I'm incredibly excited and bullish on that as well in LinkedIn. And I think I'm thinking of it more and more as a product now. I think before I thought of it as a tool, kind of as you said, but I think that will, and you're obviously already seeing that that's going to become massive even before 3D printing is. So you were probably looking at the three that would come to fruition even sooner versus the 3D printing. So
Cool. Okay, so we've gotten the prioritization out of the way, and so you're in the sort of algorithmic market making community, and you start looking at the asset class. And what are some of the practical steps that you took to get Fractal up and running, and sort of like what was the initial hypothesis you were pursuing?
yeah, absolutely. So I think the first sort of signal I was looking at was just how heavily segmented the marketplace was in 2017. So while everything was mooning basically in the second half of 2017, and everyone was waking up to new gains each and every day, I was sort of obsessed with creating scripts that could pick off like a penny between exchanges, taking no risk. So I was very much trying to create basically an arbitrage strategy between exchanges, not because I really wanted to do arbitrage, but because I knew in the limited amount of time that I had on the weekends while I was working at McKinsey, that if I, as being someone who can write code, but am not like a highly polished developer, I always wanted to bring the best developers around me on teams and be able to think more strategically. I knew if I could write something that did arbitrage, that then when I found good developers around me, we could basically run after any strategy we wanted, thinking we'd quickly evolve into market making. And so once I saw that opportunity definitely exists, you could pick up pennies while everyone was getting rich in the run up in 2017. January 2018, decided, especially after running this past people in traditional markets who I respected very much, that I should jump ship from McKinsey and start Fractals. So the year of 2018 was sort of a build year. Of course, everything crashed and the market was a bear, but being sort of a builder and being a market maker, that was okay. Market makers tend to be broadly market neutral. They can overlay a lot of other strategies, but we didn't really have a strong beta exposure in the space. And we quickly evolved. Sort of the first thing that really got me going down the DeFi rabbit hole is when I came across Maker. So that was the first thing, if I'm probably being honest, that got me like insanely excited about DeFi and really even crypto and blockchain. I would say I got into the blockchain space sort of out of a more of a utilitarian approach where I was just looking at these specific signals of a segmented marketplace. Then when I saw what Maker was doing, and at first was trying to classify in my head how this is fundamentally different, I realized that, okay, the big innovation here is actually the smart contract. The blockchain, yes, but it's the smart contract and the things you can build on top of it and having these protocols that actually run. So I became fascinated with that, which sort of led Fractal down this path towards DeFi, which at the time was maybe only vaguely called DeFi. We were referring to it as that, and some people were, but it wasn't a really commonly used term yet. And so we got very active as a 0x market maker, as well as the different order book groups that were built on top of 0x. And then, of course, as Uniswap and SushiSwap took off and the various AMMs going forward, we were active there. So we sort of found ourselves positioned in the perfect place, given that we became very interested in decentralization and tried to get ahead of this, saying, okay, this has to be where the industry is going, because if these things exist on the blockchain, I didn't see any world where trading and lending and other financial activity using these tokens would not be also done on the blockchain.
So let me pause you there just for some definitions in terms of what does it mean to be a market maker on 0x versus what does it mean to be a market maker on an AMM, an automated market maker pool? What does it mean to provide liquidity? And then what's the capital market structure that you were participating in and arbitraging or making more liquid?
Yep. So I'll hit the thing you said last first, and then I'll go back to kind of how to find these. We really only focused on arbitrage probably for the first 6 months of Fractal being in existence. And that was a little bit by design. I sort of knew going in that, hey, the arbitrage will be there and it will always be there for the most innovative personnel. But I was always, well, arbitrage is actually, arbitrage gets often a bad name, but you can very much make the case that someone needs to bring the markets into alignment. So I'm not one to give it a bad name, but we just sort of knew that we were more interested in sort of broader utilities into the market as opposed to arbitraging. And we didn't necessarily want to always go to war to be the fastest at something or the best at one thing. We wanted to take more of a holistic view in the markets. So when we sort of evolved beyond arbitrage into market making, what we realized, or the signal we looked at, was different builders in the space, often founders on teams, were looking for liquidity or for market making services for their tokens. And this could be in centralized exchanges like Coinbase and Binance, where we are active. It could also be decentralized venues like the 0x's of the world, as well as the various AMMs, so Uniswap and SushiSwap. To your question, those are pretty different, at least back in a V2 world, those were pretty different activities. In the case of Uniswap and SushiSwap, being a market maker basically meant you were acting as an LP into those protocols. And probably a number of your listeners are familiar, maybe have done this themselves. You'd take, if you were market making for a protocol with a token called ABC, you'd take ABC and ETH and deploy it as an LP into Uniswap or SushiSwap. And then it really just becomes a question of hedging your exposure. So as people are buying or selling it, your pool is the one buying and selling. So you have to get used to how your position is moving and then buy and sell accordingly on other exchanges to keep yourself balanced as a market maker. So that's sort of one bucket. The other, which is a much more hands-on approach than that, is 0x market making. So 0x at the time when we started was all an order book model, which means you were putting bids and offers in. And these were essentially off-chain order book models that then the taker or the trader that came to interact with your order would come and fill it on chain. So you think of it as sort of this array of orders that could be filled, and the trader that fills your order takes those things on chain. That ends up being, you had to build a much more bespoke tech stack in order to do that. And the name of the game was and still is managed gas fees. So in the 2018, 2019, early 2020 timeframe, gas was much, much cheaper than it is now on the Ethereum blockchain. But it still meant if you were in the world of being a market maker, you need to cancel orders when the market moves and then replace orders, all of which cost gas. So you can imagine how crazy expensive that was. And early on when we started, being a very small firm, I think the first week we turned it on, we maybe had, I was self-funding everything at the time. We had maybe 4 to 6 weeks of runway based on the amount of gas that we were paying when we first turned it on. But we reduced that by like an order of magnitude or more very quickly with a lot of optimizations we did. 0x over time evolved into an RFQ model as well, which is where they're finding some success now because it's much, much cheaper than having to host an order book in real time and paying gas every time the market moves and you need to cancel and replace bids and offers.
Awesome. Thank you for laying that groundwork. And, I think one of the key ideas that you mentioned up front is projects need market making services when they launch tokens. So each individual project, you can think of them as startups, you can think of them as companies, you can think of them as groups of people wearing silly avatars on Twitter. They issue some sort of tracker to their performance or community or activity. And then every time somebody does that, the tokens have to go somewhere. They have to be accessible to a user. And we've at that point have left the world of needing to list everything on Binance or Coinbase or some other exchange, but rather create essentially open source ways that people could stand up trading and financial participation, but also community participation in all of these projects. And this market making activity is literally the unlock for people to be able to do that. And so we've had this industry structure, for at least a year, and then things started to change. And now people are pointing to the second version of DeFi as well as new versions of protocols. Can you talk about what has changed in the market structure of DeFi and then what you're trying to accomplish with Tokemak in that new world?
Yeah, absolutely. So I think you said it, you gave a very good overview of sort of the state of these different projects or DAOs, whatever you want to call them, and their need. Like a simple way to see it when we were looking at things sort of in the 2019, 2020 timeframe was here's all of these builders that are token rich and liquidity poor, which is interesting because the tokens are the things you need for liquidity, but there just wasn't the infrastructure for liquidity or market making. And so Tokemak was really built with builders in mind. And the sort of analogy going back to the Tokemak in plasma physics is that, or in that fusion reactor, is that the Tokemak is the liquidity reactor to power DeFi. One interesting analogy that we saw talking with a lot of different builders and founders in the space was liquidity and market making was taking like a huge amount of mind share out of really innovative people that were building awesome new products. So you'd talk to some founder and like it seemed like 60% of their time and headaches was worried about liquidity and market making. And this was sort of reminiscent of the late 90s, early 2000s when you had internet companies that out of necessity were running massive IT farms or spinning up massive server farms and employing massive numbers of IT professionals just to sort of host their sites or their products. Then you had Amazon come along and say, hey, we've got this covered in the cloud. Here's AWS. Go build your product on top of it. That was sort of something similar that we were thinking of with Tokemak, which was all of these groups are either paying a huge amount for market making, often on centralized exchanges, or they're budgeting a huge amount of inflation, so meaning emissions of their tokens to secure liquidity. And again, this was occupying a lot of time rather than them focusing on building products. So the goal with Tokemak was similar to kind of Amazon with AWS. Let us handle the liquidity, you go out and build, and we'll bootstrap that. By watching all this, we really started to sort of take this view that liquidity is the next critical infrastructure layer. And the way you can kind of see that is data flow, which is how things move around in Web 2, is being replaced with value flow. So tokens moving around and exchanging for other tokens in Web 3. And in a Web3 world of value flow, liquidity essentially plays the role of bandwidth. So, given that, the goal then with Tokemak was to increase liquidity bandwidth across the ecosystem, deepen liquidity everywhere, which is good for all participants, means better spreads, better execution, better pricing, and really become sort of the broadband moment for liquidity bandwidth in DeFi.
So I think I'd like to double click again, and my read on what it means to be a liquidity aggregator is that you're almost, whereas Fractal was acting as a market maker for projects to help them out when they were sort of stuck or they had a chicken egg problem, Tokamak is a programmatic answer at an industry level to create an aggregator of market making that touches a whole bunch of different projects and then intermediates the incentives through token emissions and token distributions. And those tokens are the native tokens of Tokemak that then kind of go into different reactors and things like that. Can you just open up this concept as as simply as possible? Like, is this right? Or like how does it work? What's the purpose of the Tokemak token? Like, how does the whole meta system come together?
Yeah, everything you described is correct. And the way that we sort of think about this is in the kind of early to mid 2020 timeframe, we became obsessed with like what it would look like to be a decentralized market maker. So this was again, given our position as Fractal, we were like, okay, we're doing decentralized market making, but we're not decentralized ourselves. In other words, we're not a decentralized market maker. So we started asking the question, what does it look like to decentralize a market maker, a liquidity provider? And the thing we came up with was that there's essentially three sort of buckets of things that an effective centralized market maker is combining or centralizing to be effective. One is capital, not surprisingly, in order to make the markets. A second is sort of strategic market direction. So, what asset classes should be traded, what needs liquidity, and where. And then the third is the actual trading technology and expertise. The goal with Tokemak was to decentralize or disaggregate those three things across the blockchain and enable capital to flow into the system, which is what we call liquidity providers. That's probably the least surprising of the three. The strategic direction of what needs liquidity and where is provided by what we call liquidity directors. Liquidity directors stake our native token called Toka in order to direct the liquidity to different venues. So, for example, SushiSwap or Balancer or 0x. And then the third, the sort of trading technology and expertise is provided by pricers. So this is where sort of traditional market makers plug in. if and only if they are needed. So at launch, we have support for 0x, Sushi Swap, Uniswap, and Balancer. And the one of those four that needs a pricer or traditional market maker is 0x. And so these three things sort of disaggregated across the ecosystem. The goal of this is to drastically increase liquidity for everyone, but also by removing a lot of friction, which I'll describe in a minute when I talk about the different user types, drastically reduce the cost that to DAOs for securing liquidity. So with Tokemak, they should be able to unlock at least a 10x savings in what they're paying for liquidity. And eventually they should be able to actually flip it over to a revenue generator as well for their protocol.
So this is the part where I don't know the answer before asking the question anymore. So there is some sense in which the decision where to direct the Tokemak token, powers up or deprioritizes certain pools for liquidity provision. Can you talk about the types of dynamics that you expect in that decision making of which reactors to prioritize? Like, what's the concept of like the right amount of incentive? You know what I mean? Like, isn't this super contextual based on each project? And how do you do this in a sort of system level through governance? It seems really hard.
Yep, it's a great question, and I think it will always be to some level an evolving target. But we have a pretty unique answer, I think, to that first step into this question. So some quick table setting, and then I'll get to your question. So we think of Toka as tokenized liquidity, which means the more Toka you have, the more liquidity you can direct or secure wherever you need it. So to your point, the Toka holders are trying to not only they can move their Toka to these different reactors. And when I say a reactor, it just means a pool of a given token. So say the SNX reactor or the Aave reactor, and then the liquidity directors routing that liquidity to wherever it's needed in DeFi. Now, the Toka holders have a couple different levels of decision making. The first is which reactor they want to stake their Toka to, because since it's generalized liquidity, they can direct Aave someplace, they can direct SNX someplace, they can direct Ohm someplace. That is actually covered based on dynamic incentives, which adjust based on the supply and demand of liquidity providers, so the capital on the left side of the reactor, and the amount of Toka staked, the liquidity directors on the right side of the reactor. The goal of this design, and these are really interesting equations, is that if participants are always, meaning liquidity providers and liquidity directors, if you make the assumption that they will always be greedy and try to maximize their own profits, the system will work the best. Because the system actually, if liquidity directors are in a deficit, and let's say we have a ton of Ohm in a reactor, that increases the rewards for more liquidity directors to come to that reactor and route the Ohm to various venues across DeFi. Likewise, if you had an ALCX reactor and you had a ton of Toka holders staking it there saying, I want to see ALCX liquidity and I want to direct it to various places across DeFi, that will increase the rewards for more ALCX to flow into the system. So the users are in this perpetual game of balancing the reactors, and the APR naturally moves both capital and staked Toka to where it's sort of needed in the space. And thus far, it's actually worked very well. We just initiated the game of balance the reactors last week. We turned on the liquidity director votes, and everything is staying within, I'll just pull it up right now, everything's within about a 12% spread from the reactor that's paying the least to Toka holders to the one that's paying the most. Right now, it's paying between 55 and 67 or 68% here. And so this mechanic thus far in the early stages here is working very well. So that's sort of the first part, is we design the incentives to make sure that people are getting paid the most if the system is most balanced and is providing the most liquidity across DeFi.
Just to articulate, I think, a thing in there, which is that there's like almost an embedded prediction market, right? Because the rewards that people are optimizing their own returns based on their perception of the price of whatever reward token they'd be getting as a result of directing liquidity somewhere. So they're doing this on expected returns, not returns, right? So everything's showing percent and returns, but all of these are really kind of like probabilistic calculations that the crowd is doing on how well some particular protocol is going to do, and then also trying to measure in like growth versus collapse and things of that nature.
Yep. So effectively, Early on, we actually can even control that because at first we're basically paying in toka as opposed to what the underlying pools are making while providing liquidity or making markets, however you want to say it, out in the venues. And the goal with that is in the early stages, we want to further decentralize the protocol, pay out more toka, decentralize the ownership, and have the protocol itself grow its PCA, its protocol controlled assets, by pulling in the rewards, pulling in the spread, pulling in the fees of these things. Now, over time, it gets to exactly sort of what you're saying, where right now it's a prediction market, but one that we can make good on. Over time, as you start decreasing the toka emissions and possibly supplanting those with emissions of the underlying rewards and spread that's generated, then it gets more into, okay, what is your expectation that as you direct this over here, how much will it make? Sort of what is the risk reward profile look like for a given pool?
Right. And I mean, of course, there's the fantastic crypto game, which is, assume token is valuable as a given assumption, and then because that's the case, you're able to direct financial value. Were you at all surprised, or what was your expectation around the Toka token launch and its pricing and the dynamics of issuing, an asset that's associated with this project? How did that go relative to what you were thinking at the beginning?
Yeah, I think it's gone sort of as we expected, but we were definitely expecting a very optimistic case, and luckily it's gone along those paths. So I think what sort of pleasantly surprised me was how quick people sort of understood this concept of like more toka equals more liquidity. So as sort of a few examples for the types of users and the reason why Toka has this sort of inherent utility and inherent value is if you think of things from like a DAO's perspective, DAOs are trying to secure and control more of their liquidity. And so the more Toka they hold, the more they're able to vote not only for their own project, but for others, direct liquidity to wherever it's needed. So if you're in Alchemics and you know that one protocol is interacting with you through a balancer pool, for example, then you can use your token, basically generate demand for more ALCX to flow into the system, and then direct that liquidity to balancer. On the other hand, you have exchanges, right? The liquidity recipients, which we haven't talked a lot about from Tokemak, are the underlying exchanges and AMMs. They will want Toka to do a vote the other way. So if you're Sushi Swap, you want to stake Toka to each of these reactors and direct liquidity to Sushi, because more liquidity equals tighter spreads, equals more trading volume, equals more fees. So that's sort of a quick primer on how DAOs and exchanges are interesting in this. Market makers are also interesting because those that would plug in as a pricer can start scaling up their business for any venues that require them as pricers and basically be trading more volume via Tokemak. Another, just to run down all these different users, is liquidity providers, so which are generally just the community, right? We didn't highlight this, but much easier for them to provide liquidity into Tokemak. Less friction if you just go to Tokemak. You don't have to deal with the relatively complex interaction. I think some of us that are power users don't think it's complex, but it really is to go to even Uniswap V2 or Sushi Swap and have both the tokens and put them in. There's more friction there. It's more capital efficient here. If you have Sushi tokens, you can put them in here and you don't also need ETH or USDC to pair with the Sushi. And then last, the liquidity providers are not the ones that experience IL. That's mitigated in other parts of the system, and it's different participants in the system that take the final residual risk of that. So all of these things basically make it quite interesting. And coming back to your question, there's a lot going on here, and I thought it would take quite a bit longer. I still think we're early in terms of the number of people that understand it, but the initial sort of core group that got in here, people were pretty quickly grasping the concepts, probably 2 or 3 months earlier than I thought people would start to get it.
That's awesome. And I mean, it's fundamentally fantastic and awesome to see what I think is real innovation in figuring out a structure for delivering investment and financial outcomes that are very capitalist. Like, these are things that bootstrap jobs and creative activity, and they're novel structures to do that. And to see that it's possible and that it works is really quite fantastic. I mean, thinking back 10 years and imagining a pitch for this, it would have just been psychotic. It's like, I know a bunch of people on the internet, we're going to launch a thing and it's going to be $5 billion. And then also there's going to be all these other groups of strangers on the internet. And here we are. So I love it. I want to ask one more question on this before closing with the discussion about the mechas and the NFTs, which are very cool. But the last question I want to ask, and it's a little bit of a sideways question, one that I've been thinking about, is, we have this problem statement, which is the first version of DeFi has these inefficiencies in terms of how each project bootstraps and grows, and they might not get the optimal amount of funding and liquidity. And so creating these new market structures is a very positive step forward. And so I see the world kind of split into two directions, but I'm guessing that actually you probably have a view towards how they come together. But the two directions that I see are the Tokemak direction, where you've got sort of horizontal integration of all liquidity provision through this meta market maker, which mediates and prices all the different pools in the ecosystem with a common currency, which is the sort of abstraction of liquidity. But you do have horizontal at the maximum. It's not a monopoly because this thing can be community owned, but it becomes a layer in the same way that Ethereum or another computational chain is a horizontal layer, and you can have this liquidity layer. But then you have a competing story that's now being told by Olympus DAO and and the story is about protocol control liquidity. And you kind of hit on this a little bit, but the idea there being that each project actually wants to own its pool and control it fully, because then it benefits from the revenue generation capacity of being its own market maker, and in the long run kind of shuts out other parties who might create volatility for its token supply. Are these two visions coherent together? Are they contradictory? How should we interpret the ways that DeFi 2.0 is pulling on the market structure of the ecosystem?
Yeah, it's a great question. So I definitely think these two things are not only highly coherent, but they're also self-reinforcing to a great degree. And I think for not being sort of those that probably aren't building this all day, every day, at first glance, they seem like, oh, we have to choose kind of one or the other. But our team is actually very close with the Olympus team. I talk to Zeus fairly frequently. I love everything that they're building over there. And this is the way that we kind of see this. In fact, I actually just published, you'll see, I think a link go out today, but I published an article on the 6 stages of DAOs, which is sort of going from stage 1 with the least control and security over their liquidity to stage 6, where they have the most secure and controlling over their liquidity. And we actually use Olympus Pro as sort of one of those examples. So I think of Olympus Pro and what Olympus is doing is sort of on one sort of orthogonal dimension, but still in the same set of coordinates to what we're doing. They're sort of looking at, okay, how much do you want internally to the treasury versus external? Again, this is me thinking in cartoons, and how do we then sort of optimize to bring in the amount that we want to control internally? And I think that's very important. I think it's good to have sort of DAOs to internalize that. Then what we're trying to do is basically take tokens regardless of where they are. So whether they're internally, as you would do either off the bat or as you purchase from something like Olympus Pro, how do you make sure that the tokens that are held internally to a DAO and externally by the community can be maximally used as liquidity, since liquidity is really bandwidth in the space? So these things, when paired together, are super powerful. And a kind of way to visualize this in your head is, I think of all of these DAOs, and especially as I use Olympus Pro to sort of own more liquidity, you can think of them as sort of the source, and then they will be maximal users of Tokemak. So you can think of them as the source, and then Tokemak as sort of the river or the conduit through which they can get a lot of those things deployed as liquidity broadly across DeFi. So where we think all this is going, where we're getting strong excitement from DAOs, is we think that they're some of the ultimate users of this. And we think that what Olympus is pioneering here is also a great tool for DAOs. So we think DAOs will be leveraging both of these. And if you think about what happens when you sort of marry generalized liquidity via Tokemak through a bond purchase mechanic you can get with Olympus Pro, and unlock some really, really interesting things for DAOs.
That's going to be a really interesting tapestry. It's evolved so quickly that it is just super cool. I think we're going to have to do a cliffhanger about the NFT project, which I recommend everybody check out, because it's super fun and shows that in this space you don't have to be serious to be doing very serious things. And so let me instead ask you, if our listeners want to learn more about you, about Tokemak, any other part of the things that you're working on, where should they go?
Yeah, great question. So I think playing around on the site on tokemak.xyz is great. You can sort of watch the game of balance, the reactors play out in real time. Going to Tokemak on Medium is great. I just put up an article called The Evolution of DAOs, which talks about how DAOs are sort of progressing through controlling and securing liquidity. And there's an interesting case study there with Alchemics as well as some nods to 3.3 and everything that Olympus has built. We've got some good game theory in there for for the game theory nuts. And then follow at Token Reactor on Twitter. We have a lot of good stuff from there from the official, as well as at Liquidity Wizard to follow me on Twitter. If you look at all those things, you should be well equipped. And maybe as a last one, as you start going deeper, if you jump into the Tokemak Discord from Thursday night Pacific US time to Sunday night Pacific US time, we open a channel called the Leaky Reactor, which is sort of a space cantina themed thing where everyone just sort of talks very casually and has a drink or two in there. So that's kind of a fun way to casually get introduced to the community of pilots.
Awesome. Thank you so much for coming on. It's been a fascinating conversation. I love how many of the threads that you've started with have come together into this pretty groundbreaking project. And I'm hoping we can reconnect in less than 2 years and make even more progress.
Absolutely. Thanks so much, Lex. This is great, and reach out anytime we can dig deeper.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.